spend so much time obsessing over the stock market. We're constantly watching those flashing red and green tickers, right? But there's actually a hidden engine running beneath all of that noise. Welcome to This Explainer, where we're going to tear down the walls and look at the invisible macroeconomic forces that are silently impacting our wealth, literally every single day. We're talking about a foundational system that quietly dictates exactly how money moves across the entire globe.
So, think about this for a second. What invisible force actually dictates global wealth? I'll give you a hint. It's not tech stocks, it's not real estate, and no, it's definitely not crypto. It is a massive, constantly turning system operating entirely in the background. It sets the absolute baseline cost of money itself, and ultimately, it decides the fate of your investments, your savings, and your purchasing power.
That hidden force is the global bond market, and it is valued at $145 trillion. Just let the sheer scale of that number sink in for a minute. 145 trillion. It completely dwarfs the global stock market. It's like the deep, powerful ocean current of global finance. And to really understand how this absolute behemoth eventually trickles down to affect your own personal wallet, well, we've got to understand the fundamental mechanics of how it actually operates. To navigate this space, we absolutely have to grasp what I like to call the one rule of the bond market. This is the absolute foundation. It's basically the fundamental law of gravity for this entire $145 trillion machine. And the beauty of it is, if you can understand this single core rule, suddenly all those complicated financial headlines are going to start making perfect sense.
Okay, so here it is. It's an absolute inverse relationship. When interest rates go up, bond prices go down. Simple as that. It's like they're sitting on opposite ends of a seesaw. Think about it. When central banks raise rates, new bonds are issued at that higher, more attractive interest rate. So those older bonds that are stuck paying a lower rate, they suddenly become way less attractive to buyers. Because of that, their market price drops to compensate. Rates up, prices down. But the true impact of this rule is actually hidden a bit deeper within the machine's mechanics. Let's dig into that.
And that brings us to the hidden lever. We call it duration. So while our seesaw rule tells us that bond prices will drop when interest rates rise, duration tells us exactly how hard they're going to crash into the ground. It is the absolute primary risk lever inside this market. And honestly, it's something that so many everyday investors completely miss, usually right when they think they're playing it safe. Duration is just an incredibly vital metric. Basically, it estimates exactly how much a supposedly safe bond investment will decrease in value for every single 1-point rise in interest rates. You can really think of high duration as a ticking time bomb sitting silently inside a portfolio. The longer the time frame until a bond matures, the higher its duration is going to be, and consequently, the larger the explosion to your portfolio value when interest rates inevitably shift upward. Let's look at where this time bomb actually goes off. Say you're holding a short-term bond, and rates rise by 1 point. The impact on its price? Minimal. Barely a scratch, really. But a long-dated bond fund that locks up money for decades, which makes its duration metric incredibly high. When rates rise by that exact same 1 point, the long-dated fund takes a massive, painful hit. Basically, high duration forces supposedly safe, long-dated funds to behave exactly like highly volatile, super risky stocks. Now, I really want to be clear here. This is not just academic, financial theory we're talking about. This is a very real, very present danger. To understand the gravity of duration risk, we literally only need to look in our rearview mirror to see a massive, real-world detonation of this time bomb. Let's look at the absolute financial fallout that happened in the year 2022. Back in 2022, the classic heavily relied upon 60-40 portfolio, 60% in stocks, 40% in bonds, experienced just a spectacular failure. Why? Well, central banks were rapidly raising interest rates, and those aggressively rising rates violently triggered that exact duration risk we just talked about. The traditional portfolio hedge completely failed. For decades, investors were taught that when stocks lose value, bonds are your parachute. They go up or at least hold steady. But because of our one rule and that duration lever, stocks lost value and bonds simultaneously crashed right alongside them. There was absolutely nowhere to hide. So clearly, the bond market can destroy wealth if you ignore its mechanics. But it does something else too. It actually acts as a macroeconomic crystal ball for the broader economy, because you have trillions of dollars constantly actively betting on the future path of interest rates and economic growth. The bond market provides us with one of the most reliable forward-looking indicators in human existence. And that brings us to a frankly staggering track record. 10 for 10. This refers to a specific bond market indicator known as the yield curve. When the yield curve inverts, which just means short-term bonds suddenly start paying higher interest rates than long-term bonds, it is essentially screaming that trouble is ahead. Just how accurate is it? Well, it has predicted every single one of the last 10 recessions perfectly. 10 for 10. It is a macro signal we absolutely cannot afford to ignore.
Okay, so we've talked about the $1,450 trillion macro machine. We've talked about global recessions, portfolio theory, all of that. But let's bring this right down to earth for a second. Let's pivot from the global macro market straight down to your own wallet, your everyday savings, and the real-world cost of these mechanics. Because make no mistake, this machine impacts you directly.
Consider this multiplier, 9.8x. Because interest rates have shifted in the market, the mechanics of where you park your cash matter more right now than they have in years. Currently, short-term government bonds, T-bills, are yielding returns that are a staggering 9.8 times higher compared to the standard traditional savings account sitting at your local bank. Let that sink in. If you aren't paying attention to the bond market's mechanics, you are quite literally leaving a nearly 10x return on your cash just sitting on the table. And then there's the flip side of that coin, what it actually costs you to borrow. This is the massive real-world cost of rising rates, $96,000. See, when the bond market forces interest rates up, it doesn't just crush long-dated bond portfolios, it crushes the everyday home buyer. That number represents the massive additional cost that higher interest rates add to a standard mortgage over the life of a loan. The mechanics of the bond market directly extracted nearly $100,000 from a standard home buyer's future wealth. That is the invisible force hard at work in everyday life. We've traveled all the way from the $14 trillion global engine right down to the monthly mortgage on a family home. You've seen the one roll, you understand the hidden time bomb of duration risk, and you've seen the incredible 10 for 10 predictive power of this market. So I'm going to leave you with this final, absolutely crucial question to think about. How is your portfolio positioned for the machine's next move? Are you unknowingly holding the time bomb, or are you utilizing these mechanics to your advantage? Thanks for joining me for this explainer. Until next time, keep learning, keep analyzing, and stay curious.